Morning, students. How are you, guys? And first of all, my best wishes to all of you uh, who might be receiving good news today, because today CA final results are going to be declared. And yes, good morning, Viraj, and good morning to all others. So, students, as I had requested you, that is to gain the understanding of the topics of the issues which are there in the chapter. So basically, today we shall be gaining an overview of the chapter generally in very simple language, in a very simple manner, without much technicalities. So I will make you understand about the working of insurance company, about the general rules and regulations applicable to insurance companies and their significance in the overall context of audit of financial statements of insurance company. And thereafter we shall do some questions, and if you have any queries, those of you who have gone through the chapter, if you have any queries, you can send your mails. So guys, you are very much familiar with the concept of insurance. It is a sort of financial service. As banking is. Okay. So Viraj, you are saying that you were thinking the result is on 12th. So have you appeared for the final exams? Did you appear, Viraj? Did you appear in May attempt? So insurance is a sort of financial service. Like we are very much familiar with that. Like we pay life insurance premiums for insuring lives. We pay motor insurance premium. Okay, for insuring our vehicle, and uh, companies pay, organizations pay fire insurance premium for insuring their assets, for insuring their factory assets like machinery, like building, like stocks. And besides, there is health insurance with which you are very familiar with. We pay a premium to ensure the risk of our health, so that if something bad happens, then the cost of hospitalization and all these things, these can be reimbursed. There is also marine insurance relating to transportation of goods from one place to another, and also relating to insurance of ships, insurance of vessels. So students, insurance is basically a contract of indemnity. Which type of insurance? Except life insurance. Because in case of life insurance, you can't put a value on it. So therefore, in case of life insurance, if something untoward incident happens and the person dies, then a sum which is decided when the policy is issued, is paid. Okay. Yes, Viraj, very fine. You are saying that you were insurance advisor of ICICI Potential Life. Okay. And non-life insurance is a contract of indemnity. So what is indemnity? Indemnity means to reimburse a person of the loss suffered, of the costs incurred. So like suppose uh, you are driving your car on a road and the car meets with an accident, so you would be able to get claim of what damages you have suffered, not more than that. Okay, so this is the meaning of indemnity, to indemnify somebody. ओके, जो उसका लॉस हुआ है उसके लॉस को पूरा करना. Okay, understood, guys? So similarly, in case of fire insurance, say if a fire happens in the premises of a company and there is a loss to stocks, then the company would reimburse the client, the insured of the damages suffered. He can't claim more than what he has suffered. Okay, so that is why we say that it is a sort of a contract of indemnity. He can't make profit out of it. So all non-life insurance contracts are contracts of indemnity. The person who purchases the policy, the person who gets insurance, he can't make profit out of it. He is not supposed to make profit out of it. Okay. So understood the nature of insurance? Now, as you have understood that insurance consists of two types of things. One is life insurance and one is non-life insurance. So non-life insurance consists of insuring risks like fire, like say burglary. Burglary, you understand, guys? That is theft. Forcible entry into the premises of somebody else. So fire, burglary, motor vehicles, and health insurance, marine insurance, and in marine cargo, marine hull. Yes, crop insurance, yes. Koshki, yes, crop insurance is there for the farmers. And many new type of products are also coming. Okay, like say even plate glass insurance. Have you heard this term, plate glass insurance? So plate glass insurance is a these days in showrooms there are fixed glasses which carry substantial costs. So there is a special type of insurance for them which takes care of their damages to them for their breakage, etc. It is known as plate glass insurance. Okay, And there is for corporates, it is loss of profits policy. That say some incident has occurred. Aviation insurance means pertaining to aircrafts. Okay. So loss of profits policy means like say fire has occurred in premises of some company or some organization. Then not only the company would be paying damages to building, damages to machinery, damages to stocks, but it would also be paying loss of profits during the period the company's premises have been not able to work, have or probably have been shut down due to the incident of fire. So there is a separate loss of profits policy, LOP, okay, which is known as insurance language as LOP. Yes, Kaushiki, what you are asking? You are saying for CA also there is insurance of any claims. Probably you are asking about insurance cover applicable to CAs. Yes, such type of policies are there in the market, like professional indemnity policy for chartered accountants, which covers probably liability arising out of their professional practice. Okay. So this is precisely, I think, Kaushiki, you wanted to ask. Yes, Namrata is already writing professional indemnity or liability insurance. Yes, Namrata, you are faster. So, and life insurance, you know that when one insures one's life, so life is very costly. You can't put a value on it. So life insurance, under life insurance, there are various products. Major products are like term insurance and endowment policies. So in term insurance, the purpose basically is to insure your risk, and the premium is also in accordance with that. And you are not getting much benefits while getting a term insurance. Basically, its purpose is mainly to insure your life risk. And under endowment policies, you also get benefits if you survive the policy period. Say policy is for 15 years or 20 years, then premium is charged from you as per your age. The more younger person, the more young a person is, the lesser would be the premium. So premium rises with the age. So in endowment policies, if you survive the term of the policy, you get benefits apart from the sum insured. You get bonuses and all the other benefits. So one of the important difference between life insurance and non-life insurance is, students, you have to understand that in non-life insurance, you are not getting any benefits out of the policy if some claim does not arise. Say you have insured your building. A company has insured its building with the insurance company, and say the company has paid premium of rupees 10,000, and it has got insured its building for rupees 1 crore. Assume, okay. But let us say that nothing has happened during the policy period. So also understand that in case of non-life insurance, the contract is generally for 1 year. Most of the non-life insurance policies are for a period of for a year. Although these days some policies, some products have come which are of shorter duration and even of longer duration, but generally substantially most of them non-life insurance products are of a period of generally 1 year. So if say some untoward incident doesn't happen, then whatever the premium the company has paid, it is gone. There is no benefit. Okay, it is only when some claim arises due to some incident which is covered under the policy, say fire has occurred, or say floods have come, or say some other this kind of incident has happened, which is covered in the policy. Say a theft has occurred in premises of the company. So only in those cases a claim would arise, and the insured would be able to get something, some value out of that. Otherwise, it would be just as an expense to be borne by the insured organization. Okay. So students, I am just trying to open you up to make you understand the basic things without referring to the nitty-gritty which is there in your module. And whereas in case of life insurance, this contract is generally a long-term contract. It can range from 10 years, 15 years, 20 years, or even more. And in most of the policies, you get a benefit. If you survive the term of policies, you get a benefit. And if some incident happens and the person is gone, he is not in this world, then his nominees or legal heirs, then they get the claim amount, which is there known at the time the policy is issued. Okay. Yes, money back policies, Namrata. Money back insurance policies in context of life insurance means policies where some payout is given to you after some period. Okay, like after 5 years, say the sum assured is 50 lakhs, then after 5 years 10 lakh is paid to you. Okay, so these type of products. So clear, guys, overview of what the insurance products are. So guys, in India, as far as India is concerned, still in our country, insurance penetration is quite low. Still, people are hesitant to pay insurance, whereas say in case of Europe or say US, the things are not so. There, the penetration of insurance products is very high. Is very high. Say you won't be able to move out before getting a health insurance on you. Because why? Because there in those countries the hospitalization cost is so much that an ordinary person can't afford to get himself uninsured. So let us take example of you students. Even those of you who are watching, who are listening, tell me how many of you have got a health insurance cover? How many of you have got a mediclaim insurance policy? Yes. How many of you have got a mediclaim insurance policy? Yes, Namrata, difference between money back and term insurance is like term insurance, the premium is premium primarily covers the risk of your life. It does not give you much benefit. Whatever the sum insured is, probably you would be getting only that much after maturity of the policy, and not any additional benefits. And the endowment policies carry benefits. Money back, I have already explained. Yes, Koshki, very good. You have got a health insurance and life insurance. And what about others? So now we come to regulation of insurance companies. So how these are regulated? Who is the regulator? Yes, students, tell me who is the regulator in case of insurance companies? So I want guys that whatever we are discussing today, at least you remember at least these things. So while you are studying the chapter, at least you remember these things. So who is the regulator in case of insurance companies? It is IRDAI. Like in case of banks, it is RBI. So in case of insurance companies, it is Insurance Regulatory and Development Authority of India. Okay. And what are the main legislations applicable to insurance companies? So two important legislations are there. One is Insurance Act 1938 and another is IRDA Act, probably 1999. Okay. And pursuant to 99 or 98, whatever it is, you can check from your module. So under IRDA Act, IRDA has issued various regulations. Okay. So various regulations have been issued by IRDA in respect to functioning of various aspects of insurance companies. Like there are regulations pertaining to investments, how the insurance companies have to make investments. There are regulations pertaining to protection of interests of policyholders. Okay. There are regulations pertaining to preparation of financial statements, with which we are concerned as an auditor. Preparation of financial statements and matters to be included in auditor's report. So there are separate regulations here. Matters to be included in audit report, auditor's report of insurance companies. So also remember that before starting business in India, any insurance company has to obtain registration. It has to obtain registration from IRDI, and the insurance sector in India, it has both private players as well as public players. Public sector players are also there, and private players are also there. Like public sector insurance companies. Yes, can you name any one non-life public sector insurance company? Yes, any one of you. Can you name any one public sector non-life insurance company? And any non-life insurance company in private sector also? Yes. Yes, you are saying yes, correct. New India and Viraj is in private sector is saying ICICI Lombard. And similarly, there are companies in the life insurance sector, like one of the largest companies we know, public sector, Life Insurance Corporation of India. And in private sector also, there are many companies operating, okay, in the life insurance sector, either in the form of joint ventures with some Indian players or else. Okay. So guys, before we move on to other things, let us understand some concepts, but some terms relating to insurance. Some terms relating to insurance, and so that it would become easy for you when you read the chapter from your modules. So one term is policy holder. So policy holder is simply the person who gets himself insured, who has taken the policy. Okay. And what are the claims? I am not going by textbook definition. I am just making you understand what the term is. Okay. And what are the claims? Claims when something happens, some event happens, and the policy holder wants to claim benefits from the policy issued, which are due to him by virtue of that contract. Okay. And there is another term which comes in case of insurance, premium. Premium, you already know that whatever amount you pay to the insurance company to get that risk covered is known as premium. So you are paying life insurance premium in a life insurance policy. You are paying any fire insurance premium in a fire insurance policy, or you would generally say you are paying insurance premium. So in case of financial statements of an insurance company, what is the main source of income? It is the premiums. These are the premium earned. And what are the main source of expenditure in case of what is on the debit side? in the financial statements of insurance companies? These are claims incurred. तो यही तो उसका core business है. Like students, in case of banks, we had seen that in profit and loss account of the bank, what was the main source of income? It was the interest received. And what was there on the expenditure side? It was interest expended. So it was interest expended on deposits and interest received on advances. These are the two core areas. Okay. Clear, guys? So claims incurred, premium earned, and one more term comes in insurance, that is reinsurance. Now, what is reinsurance? What is reinsurance? So reinsurance means that say when insurance company it gets transferred some of its risk which it has assumed, it transfers some of its risk to some another insurance company. Say how this happens is that insurance companies assume a lot of risk. So to divide their risk, once they have assumed risks, they enter into agreements with other reinsurers, and some part of risk, insurance risk, is ceded by them to those insurance companies. So the companies who are assuming these risks on account of reinsurance, these are known as reinsurers. Okay. Yes. So yes, guys. So can you take name of any reinsurer? Do you know name of any reinsurer? Yes, students. Do you know name of any reinsurer? Are you familiar with name of any reinsurer? Yes, anybody? Yes, come on, Viraj. You must be knowing. Yes. Do you know any reinsurer operating in India? Yes, guys, come on. Your level of correlating the things with current events is very sketchy. GIC, General Insurance Corporation of India, is one of the main reinsurers in India. Okay, other reinsurers are, say, Lloyd's India, and there are many others. So what happens in case of reinsurance also? When a reinsurance contract is there, when a reinsurance agreement is there, then the company cedes with the premium in accordance with the agreement. Okay, and the reinsurance company is also liable for the risks arising out of those premiums which have been accepted by it. Okay, similar thing pertains to commission also. And guys, one more important term, therefore, in case of insurance business is commission. It also it is also one of the major items of expenditure in the financial statements of an insurance company. So insurance basically operates through agency business normally, through agents like in LIC, in life insurance business, not all, and in government sector companies and in private sector companies, there are agents. There are agents who bring the business, who bring the insurance business to the company, and these agents are paid commission or brokerage sort of thing by the insurance companies in accordance with the rates specified by IRDAI. So there are stipulations, there are ceilings that say in case of fire insurance business, this is the ceiling, and in case of motor insurance business, this percentage of commission can be paid. Similarly, in case of life insurance business, there are commissions to be paid for fresh business, for renewal insurance business. Okay, and renewal, and another term now, fresh business and renewal business. So fresh business which is coming for the first time, and renewal, the policies when the customer pays premium on the same policy next year in case of life insurance business, and in case of non-life insurance product, when the customer renews the earlier existing policy by paying the premium. Okay. So clear, guys? And besides this, there are, I think, some more important terms. So before we should be clear about the terms also. And yes, one more term is actuary. Now, who are actuaries? Who are actuaries? Yes, anybody? Who are actuaries, and what is their role in insurance companies? Yes, guys, tell me. Who are actuaries? What do we mean by actuaries, and what is their role in insurance companies? Yes, Namrata, you are writing IRD is established by status. IRD is established by law. It has been established by an act of parliament. Yes, Kaushiki is writing actuaries are valuers who estimate amount of claims. You are nearing that, but not exactly. Yes, actuaries basically perform a wide range of functions, guys. Like say in case of life insurance business, they tell that what should be the premium for a particular product. They make risk return analysis. By using many statistical methods and mathematical tools. So they are qualified professional, guys, actuaries. It is a very also tough exam, and it is conducted by Institute of Actuaries in India. Okay. So they also help the companies in ensuring that their products complied with IRDA norms, with IRDA regulations. Because when a product is launched by an insurance company, say be it a life insurance product or a non-life insurance product. So product, obviously, in case of insurance business, refers to the policy which the company is going to sell in the market in the form of a product. Okay. So they also ensure uh, that the products which have been launched by the company, these are in accordance with the IRDA regulations. These are in accordance with the IRDA norms. Okay, so because when the product goes for vetting to IRDA, IRDA doesn't reject it. Okay. And say in case of non-life insurance business, um, they also, besides doing this thing, they also see that they also make an estimate of the claims which may not have been reported. Okay. Or which might have been incurred and these may not have been reported. Then you can say how actuaries would estimate that claims might have occurred, but they might have not been reported. So they do so by past experience. Okay. By using statistical models and by making data analysis and by adopting such kind of methods and techniques, they estimate these liabilities. Okay. So clear, guys? Actuaries, you have to understand, students, this much only. As far as the content of your syllabus is concerned, you have to understand this much. If you are able to retain even this much, if you are able to retain remember this much till the time of your exams, it is sufficient. Okay. And another important person in case of uh, insurance business is surveyor. More so in case of non-life insurance business. So as per Insurance Act 1938, insurance companies have to get the claim. Yes, Kaushki, you are right. So surveyor, in case of non-life insurance business under Insurance Act 1938, insurance companies have to get the loss assessed from independent surveyors. From independent surveyors, independent insurance surveyors who are having a valid license given by IRDA. So like in case of, say, fire claims, some fire occurs in premises of a company, then it is not that the company officer would go and he would estimate the loss, and whatever the client has said that my loss is 1 crore, and company is sitting there with a check in its hand of 1 crore, and it would hand over the checks. No, it is not like that. It does not operate like that. So what happens is, so guys, I am trying to explain you the things practically, okay, so that so that when you read from module, it becomes easier for you to understand the things, to keep the things in proper perspective, to learn the things in proper perspective. So say a claim has arisen, and then what happens is, then the insurance company appoints an independent surveyor, which is on its panel, who is having a license, who is having a valid license to act as a insurance surveyor and loss assessor. And now he goes to the premises of that company. He verifies all the records. He makes physical observations, like he would ask the insured, like say in case of fire, let us assume, he would ask the insured to arrange for physical verification of fire affected stocks. Okay, he would ask them to segregate saved stocks from damaged ones, and to arrange for counting or weighment or whatever procedures he would be adopting in those circumstances for in relation to the loss. And then he would call for all the documents from the from the company, from the insured. He would require all the bills, he would require stock records, he would require books of accounts, he would require balance sheets of the past years. And then after correlating his physical observations with all the records which are given to him by the company who is willing to take a claim, then the surveyor gives his report. Remember, he is an independent person. Okay, so he gives his report, he gives his findings, and he assesses the loss particularly. So in particularly, he assesses the loss. How to assess what amount is payable by the insurance company to the insured, to the company. It is his duty, it is his responsibility to make a recommendation to the insurance company of the liability which has fallen because of this risk happening, this risk materializing. Okay, clear? So you are clear about the role of surveyor. So this is one of the term. So say in case of in this case, say the company has given an estimate of loss of 1 crore. It may so happen that surveyor gives his report that loss is for only 25 lakhs. It may so happen because of his findings. Okay. And students also remember that chartered accountants, CAs, can also act as insurance surveyors after obtaining a license from ITA. They are also qualified to act as insurance surveyors apart from engineers and other professionals. Okay, students, so clear to you? Now, yes, somebody had asked that who appoints auditors of insurance companies? So I would like to ask this question from you itself, you yourselves, guys. Say we are talking about a public sector insurance company, a government-owned insurance company in which government is the major stakeholder. Public sector insurance company, in which the government is the major stakeholder, central government is the major stakeholder. Then who would appoint its auditor? Who would appoint its auditor? Yes, CAG. Koshki, right? Under section 139, subsection 5 of the Companies Act, the auditor of a government company is appointed by Comptroller and Auditor General of India. So perfect. The statutory auditor would be of insurance company is appointed by CAG. Why? Because it is a government company. So CAG invites the panel, and those persons who qualify the criteria devised by CAG, they get to perform audit of public sector insurance companies. Okay, and simultaneously, what other powers does CAG have in this respect? Now, statutory auditor would be giving his report on the financial statements of the company, expressing his opinion on the truthfulness and faithfulness of the financial statements of insurance company. And what other powers does CAG have in respect of such audits? What other powers does CAG have in respect of audits of such companies? Yes, anybody? Can anybody tell? Yes, students, can anybody tell what other powers does CAG have in respect of audit of such companies, such insurance companies in which government is the major stakeholder? Government is the main stakeholder. Yes. Anybody? So a little bit scratch your knowledge of Companies Act, students. You have been reading these silly things since your CA inter. No, to make investigation, review reports. Yes, Janvi, little bit correct. So write specifically, students. So CAG has power to test audit or to conduct a supplementary audit. Or to conduct a supplementary audit under section 143, I think it is subsection 6. Under section 143, subsection 6. Say once the auditor, statutory auditor has given his report, statutory audit report, he has given his independent auditor's report expressing an opinion on the financial statements. Then after that, CAG can conduct a supplementary audit. So what basically does CAG does in supplementary audit? It does not conduct a detailed audit. It is limited to mainly to the inquiries of the statutory central auditor. Say after seeing his report, he has some questions in mind, that then he inquires and makes certain broad checks on the financial statements of the company, and he gives his supplementary audit report. Okay, so this is there within the Companies Act 2013. So you have been reading this from your intermediate, but still you do not remember, guys. And also another important thing in this matter is that in case of government companies, like this is also a government company, CAG has also power to issue directions to the statutory auditor. Now, this is also very important point, guys. CAG has also power to issue directions to the statutory auditor in respect of the audit to be conducted by him. He can issue directions on, say, 5-6 points, like in respect of those points, the statutory auditor would have to specifically comment. It would have to specifically report. Okay. And in case of private insurance companies, Janvi is already writing that auditor is appointed by shareholders in AGM. No, Namrata, not another auditor is appointed to conduct supplementary audit. A CAG, a staff of CAG, office of CAG, some official of CAG conducts supplementary audit. So it means that he makes certain inquiries from the statutory auditor, and he carries out some broad checks on the financial statements of the company. This is what it is meant by supplementary audit. Okay. Now, Kaushiki, you are asking about panel of auditors. Now, these are practical things. Why you are getting worried about the panel of auditors? There is a form on the website of CAG which is hosted every year, and it includes names, details of partners, how much experience they have, what is the standing of firm. So CAG allots weight to all these things, and depending upon these weights and the overall standing of the firm, overall standing of the partners, okay, the turnover of the firm. So on all these criteria, CAG gives a score to the firm, and based upon that score, it allots the audits. Okay. Clear, guys? So now as auditor of insurance company, you are basically concerned with an important set of regulations. Which are known as preparation of financial statements, and matters to be covered. Preparation of financial statements and auditor's report of insurance companies. So these are IRDA preparation of financial statements and auditor's report of insurance company regulations 2002. So these are the most important regulations with which a statutory auditor of an insurance company is concerned with. Okay, so these regulations, students, are in 3 schedules. So this you have to remember. Schedule A contains regulations relating to life insurance business. Okay, and Schedule B contains regulations pertaining to non-life insurance business. That is general insurance. Okay, and Schedule C contains matters which are to be given by the auditor in his auditor's report. Yes, clear to you guys? So there are a set of regulations. IRDA preparation of financial statements and auditor's report of insurance companies regulation 2002. Now these are in 3 schedules. So there are 3 schedules to these regulations: Schedule A, Schedule B, and Schedule C. Schedule A is applicable to life insurance companies, B is applicable to general insurance companies, and C pertains to auditor's report. It is common to both. Okay. So each schedule. So what is contained in those schedules? What is contained in Schedule A and B? Now, in every schedule, either in A or B, so let us assume anything. Let us assume Schedule A, which pertains to life insurance companies. Okay, so it consists of 4 parts. Part 1 pertains to accounting principles. For preparation of financial statements, which states accounting principles for preparation of financial statements of a in respect of a life insurance company. And what does part 2 contain? Part 2 contains disclosures forming part of financial statements. Okay, and part 3 contains general instructions. General instructions for preparation of financial statements. And what does part 4 contain? Part 4 contains contents of management report. So we shall be discussing right now what is management report after this. So keep some patience. So this sequence you have to remember that each schedule contains 4 parts. Schedule A is applicable to life insurance, B is applicable to general insurance. Each schedule is divided into 4 parts. Part 1 contains accounting principles. Now these are IRDA regulations. IRDA states that these accounting principles have to be followed by life insurance company. by general insurance company. And part 2 contains disclosures which are required to be made in financial statements, and part 3 contains general instructions for preparation of financial statements. Like in case of Schedule 3 of Companies Act, you have got general instructions for preparation of financial statements. So, and part 4 pertains to contents of management report. That what does a management report include? What is to be included in a management report? Okay. And these and before we proceed further, these regulations also state that financial statements of an insurance company are to be prepared. These are to be prepared, and these consist of balance sheet, revenue account, okay, revenue account, profit and loss account, and receipt and payment account. So the auditor has to give his opinion on all these items, on all these individual financial statements. Okay. So balance sheet, you know. So what is revenue account? So revenue account is basically a technical account relating to the operations of the insurance company. Like I'll show you. It shows a premium received and claims incurred. Okay, and commission paid, and resultant profit, which has profit or loss which has been obtained, and this profit is later on carried forward to profit and loss account. Okay, so basically it is a revenue account shows the functioning of the core area of the working of the insurance company. Okay, and profit and loss account. So whatever profit has been brought forward from revenue account, then against this there are expenditures. Yes, like trading account. Yes, Kaushiki, you are saying it right. I didn't want to speak. I didn't want to correlate like that, but exactly it is that you have understood rightly. And what is receipt and payment? Receipt and payment, it is nothing but cash flow. Yes, Namatar, revenue account, because it is legally mandated there. It is prescribed there in the regulations, because it distinguishes the core working. It separates the core working relating to obtaining of premiums and incurring of claims from other workings. Okay, and there is receipt and payment, which is in nature of cash flow. And there is also stated in these regulations that cash flow has to be prepared. That cash flow has to be prepared by the insurance company using direct method. Using direct method. So remember, guys, yes, Do you remember direct method of preparing cash flows? Yes, refreshen of your intermediate knowledge. Yes, yes, guys. Do you remember direct method of preparation of cash flows? AS3. What is direct method? You remember AS3? Yes, guys, come on. You remember AS3? What is the direct method of preparing cash flows? Yes, just enter. You have to enter direct. You have to enter receipts, gross receipts, and payment. In comparison to indirect method from which cash flows are prepared using net profit as a base, and then certain adjustments are made relating to assets and liabilities, like increase in assets and increase in liability. Increase in liabilities is a source of funds, and these sort of things. So this cash flow has to be prepared using direct method. Okay. And one more important thing is that revenue accounts have also to be prepared in accordance with keeping in view contents of AS17, sorry, segment reporting. So for all the three segments of insurance, say we are talking about general insurance business. So for all the three segments, fire, marine, and miscellaneous, separate revenue accounts would be prepared. Okay. So for fire, for marine, for miscellaneous, separate revenue accounts would be prepared, and whatever the profit or loss, whatever is coming through these revenue accounts, this is carried forward to profit and loss account and balance sheet and cash flow, receipt and payment account. You already know. Okay, so as very simple, guys. More than half of my work is done. Okay. So guys, do not forget to remember the basic things. So what is the basic thing in an insurance company? That at least you have got to remember in your mind. अरे भाई कौन सा एक्ट एप्लीकेबल है, कौन से रेगुलेशन एप्लीकेबल है, फाइनेंशियल स्टेटमेंट्स में क्या क्या इंक्लूड होता है. आप how you are going to answer the questions pertaining to these if you do not have understanding of these terms. Okay. Yes, guys, clear? Okay. So before we come again to nitty-gritty of something of these revenue accounts, let us discuss about contents of the management report, because this is a term peculiar to insurance companies. So now we know that that insurance companies have to prepare a management report. Okay, it is there in part 4. It is there in part 4 of regulations. Say we are talking about general insurance business. Now I am taking all the examples of general insurance. So part 4 of schedule B of what? IRDA regulations 2002 relating to preparation of financial statements and auditor's report. So this is the name of regulations. So part 4 of Schedule B of IRDA regulation contains contents of the management report. Now here the management prepares a report in accordance with what information is required under this management report. Now it includes information on a lot of matters. There are about, I think, 15-20 points. So basically, it asks the management to state whether your license to operate insurance business was valid during the year. Okay, whether it was got renewed. Okay, whether the company has paid all the undisputed statutory dues. Okay, compliance relating to share transfers. Relating to shareholding pattern and share transfers. Okay, that all the shareholding patterns and share transfers are in compliance with the statutory norms. Say, because why this is so, guys? Because a lot of private companies are coming in and foreign players are also coming in insurance sectors. So it asks the insurance company to make an express assertion, to make an express declaration that they have complied with all the norms relating to shareholding pattern, relating to share transfers. Okay. And another important thing, it is to be stated that solvency margin has been adhered to. Now you would say, what is solvency margin? Yes, Namrata, I have already answered your question. You are asking why it is so. So before you have asked, I have answered your question. Solvency margin. Now solvency in insurance companies, the most important ratio, students, is solvency ratio. Now you have to understand that much, that there is a formula by which solvency ratio is calculated. You need not go into that formula because it is quite detailed one. And you have to understand what is the significance of this ratio. What is the importance of this ratio? Solvency ratio basically means that the company is financially sound, that if some claim comes, then the company is expected to meet its liability. Meet its liability. So basically, it refers to excess of assets over capabilities, over liabilities. So how it is calculated? That is a quite detailed one, and anyway, it doesn't form part of your syllabus. So you have to remember that much, that solvency margin reflects on the financial soundness of the company, and minimum solvency margin of 150% or solvency ratio of 1.5:1 is mandatory for insurance companies. Okay. And there are other matters, like in case of non-life insurance companies, it has also to be stated aging of claims of past 5 years. Namrata, you have to remember this much only, that solvency ratio is 150%. Okay, I have told you it is not a simple that 150% of that. 150% is a ratio arrived at by dividing some items by others, and there are detailed forms prescribed by IRDA to state what items are to be included in numerator and what items are to be included in denominator. Okay. So aging of claims of past 5 years. So says balance sheet of 31st March 23 is being prepared. So including that year, 4 years beyond that. Okay. So what was the aging of the claims? So claims paid in band of 30 days, within band of 30 days to 6 months, 6 months to 1 year, 1 year to 5 years, and more than 5 years. What are the number of claims and what is the amount settled? And this reporting is also to be made. This reporting is also to be made segment wise. Okay, separately for different segments. And there are also disclosures regarding overseas operations of the companies. If some companies have got overseas operations, these are also to be disclosed. And there are also to be also important disclosure about the investments made by the insurance companies, that these are in accordance with the norms, in accordance with regulatory norms. So insurance companies, students, you have to understand they are making lot of investments in government companies, in equities market. They are making a lot of investments because they are having substantial funds, and claims would be arising on a future date. Suppose I am an insurance company and accepting a premium. It is not that as soon as I accept premium, some claim would arise. Obviously, it may or may not arise on a future date. So with that time lag, they have sufficient funds to invest. So investments are also a very important item in the financial statements of an insurance company. Okay. So obviously, like in case of banks, there has to be a proper internal control over investments, over how the investments are made by the insurance companies. And like in case of banks, we have learned that there are front office operation, middle office, and back office operations in the treasury department of the bank. Similarly, in case of insurance companies, this kind of segregation of duties is there, and they make investments in accordance with the regulatory norms of IRDA. They have to comply with the regulations made by IRDA in this regard. Okay. So some of the points of management report you have to discuss. You can go through the module and you understand that these are on the same lines, like 7-8 points we have discussed. Okay. Okay, guys. Is that clear what the management report is all about? Remember its name, management report. And what is its significance for an auditor? Yes, tell me. What is its significance for an auditor? Why it is being taught to you? Yes, can anybody Can anybody tell yes? Any guesses? Any guesses out there? Yes. Yes. So students, because the auditor would be certifying, he would also have to state that there is no inconsistency in the management report. That whatever management is asserting in the management report, it is not inconsistent with financial statements, with this report. Okay. Yes, clear to you guys. And there is also a requirement relating to internal audit, that internal audit system is commensurate with the size of the company. Now, now we coming to students revenue account, which is the main thing. So taking example of general insurance business. Now we are talking about revenue account. So students, there are few important terms which you have to understand in relation to revenue account, or generally in relation to preparation of financial statements of a insurance company in general insurance business. One term is premium received in advance. And another term is premium unearned or unearned premium. Yes, the auditor has to state that he has not express an opinion, but he has to state that he has not found any inconsistency in the management report. So what is premium received in advance? Yes, yes, students. And what is unearned premium? So premium received in advance simply means, say students, that suppose a company has given check to its agent dated say 25th March 23. Okay. Also assume that the policy is continuing. It is continuing policy. Last time also it was there, and this time also it is there. Okay. And so the company wanted to make sure that it pays the premium on time, and it doesn't happen that its policy is not renewed on time and they are left uninsured at any point of time. Okay. So generally what happens is नुकसान भी तभी होता है जब आदमी अनइंश्योर्ड होता है, प्रीमियम देना भूल गया, तो पता चला नुकसान भी हो गया, पीछे से कंपनी में फैक्ट्री में आग लग गई। ओके, सो डेटेड 25th March 23 and say policy the previous policy is expiring on the midnight of 31st March 23. Okay, so risk is to commence from 1st April 23. But the agent has deposited the check, okay, in the bank account. He has lodged this check with the insurance company and it has been deposited by the company. But risk is to commence from 1st April 23. So this premium which is paid before the due date, as Viraj is saying, so this is a premium received in advance. So where it would be shown? It would be shown as a current liability. Clear, guys? So, and another thing is unearned premium. Unearned premium. Now, what is unearned premium? So, unearned premium is, students, like say a company takes a policy today on say 5th of July 23. It takes a fire policy. Now policy is for 1 year. Say it has got its stock insured for rupees 5 crore by paying the premium. Okay, so the policy is valid from 5/7/23 to midnight of 4/7/24. This is the policy period. I have told you that general insurance policies are normally for a period of 1 year. So say the premium amount is 50,000, assume. Okay, then premium for this year, this financial year, should only be this much, which relates to period between 5/7/23 to 31st March 24. The rest is to be allocated to the succeeding period. So this is unearned premium. This is unearned premium to be allocated to the succeeding period and then charged to the shown as premium in the next year. So for this year it would be a liability. Okay, so this is the concept of unearned premium. Unearned premium. Now, yes, students, which accounting concept is involved in all this? So when you are allocating future premium, so which accounting concept is involved in this? Yes, basic intermediate level question. Yes, guys. Which accounting concept is involved? Which principle we are referring to? No, accrual. No, how you can say accrual? So the yes, matching. Yes, Viraj. Okay. So now we go to and how it is done, guys. How it is done. So the companies are making. So the companies are making a reserve for unexpired risks. Reserve for unexpired risks. Okay. This is there. This is there uh, in the accounting principles which are there in the schedule B. So normally revenue is recognized on the assumption of risk. The premium is recognized on the assumption of risks in insurance companies. This also you have to assume. Say you have to understand. Say you have received the premium, but you would recognize the premium. Sorry, you would recognize it as income. You would recognize it as revenue only when the company assumes risk. So risk assumption date is important. रिस्क assumption, रिस्क कब से शुरू हो रहा है, what is the risk commencement date. Okay. And a reserve for unexpired risk is created for each of the segment. It is created separately for each of the segments. So what are the three segments we had discussed? Fire, marine, and miscellaneous. So for all of these three segments, a reserve is created for unexpired risks. So what does this reserve represent? It represents that part of premium which is attributable to succeeding periods. Okay, calculated on the apportionment basis, calculated on the time apportionment basis, and this forms part of unexpired risk reserve. Okay, so it becomes part of reserve for unexpired risks. Clear, guys? So a reserve for unexpired risks is created in respect of each of these segments, in respect of fire, in respect of marine, in respect of miscellaneous. Okay. Okay. Clear to you guys? So now this point is clear to you. Now we were talking about main items in the revenue account. So one item is premium earned. So what is included in this premium earned? So premium from, it is segregated as premium from business in India. Now we are talking about general insurance business. Premium from business outside India. Okay. And then there are certain adjustments, that is there add premium on reinsurance accepted. Say if the insurance company has itself accepted some reinsurance premium, okay, then it is a then premium would be added, and the premium which is ceded, on which risk has been passed to some other insurance company, to other reinsurer, then premium on reinsurance ceded. So after this is the net premium, and after that there is adjustment relating to change in reserve for unexpired, change in reserve for unexpired risks as compared to last year. So this is how figure for premium earned is arrived at. Okay. So similarly, in case of claims incurred, so how these are arrived at? Claims paid. Okay. So these are in fact the claims paid which have been paid. चेक कंपनी ने इंश्योर्ड को पॉलिसी होल्डर को दे दिया, द मनी हैज बीन ट्रांसफर्ड, द क्लेम हैज बीन पेड. ओके. सो एड क्लेम्स ऑन reinsurance accepted. Less claims on reinsurance ceded. So जिसका आपने रिस्क ट्रांसफर कर दिया उसका इंश्योरेंस रिस्क आपने सीड कर दिया तो उसके क्लेम्स भी सीड कर दिए. ओके. So this gives us to figure of net claims paid. Okay. And after that it is add claims outstanding at the end, like we make adjustment in case of closing stock. Similarly, less claims outstanding at the beginning. And here we arrive at figures of claim incurred. Okay. So students, you have to understand that claims outstanding is one of the major item in the financial statements. Okay, claims outstanding. So there might be claims which are outstanding in the balance sheet, in the financial statements of a company, because the claims have not been settled. Although liability is there, but the claims have not been settled. Like it may so happen that in case of a fire insurance claim, the surveyor has not submitted his report till the end of reporting date, till the end of financial year. Okay. So in that case, the company would have to make a provision because there is a liability to pay the claim. There is a liability to pay the claim. So the companies would be requiring to make these sort of provisions in their books, and these liabilities are huge because, say, some claim happens in month of January or February. It is not that surveyor is going to submit his report immediately. It will take him months to submit his report. Okay, so clear to you guys? So we have, I have tried to explain to you students some general things relating to working of insurance companies, relating to working of uh, insurance business, of life insurance business, of general insurance business, and a few more important terms relating to insurance, life insurance business uh, are policy lapse, policy revival, and policy surrender. Yes. Can you make a guess of these terms? Yes, guys. Yes, students. Can you make a guess of meaning of these terms? What do these probably mean? Policy lapse, policy revival, policy surrender. Yes, Viraj, you must be knowing. You have already worked in ICICI Prudential. No, Kaushiki, lapse doesn't mean term has ended. That means maturity. When the term has ended, say I have taken a life insurance policy for 15 years and the policy is going to end today on 5th July. It means the term of policy is complete. Policy period has ended. It would result into the maturity of the policy and the company giving me the required benefits which are due under the policy. Yes, yes, Viraj, it is right. Viraj is saying that policy lapse means that in case of life insurance policy, say the premium is not paid on due date or whatever the grace period is given by the company, and after certain time, what is which is in accordance with their internal control mechanism, which has been devised by them, and relevant regulatory norms, regulations, the policy shall lapse. It means that policy is no longer, it is no longer live. It is in past. Like this lecture, when it would not be live, it would be available in recorded version. Okay, even then it would be of some use. But that policy which is not live, which is not current, that would be of no use. Okay, it would lapse. So, and what is policy revival? Policy revival means that you can within some time limit you are able to revive that policy after removing those deficiencies out of which the policy lapsed. Say the premium was not paid, so you can pay the premium along with interest, and say probably if you are above a certain age, you may have to go then for a medical examination. Okay, for revival of the policy. So these kind of things. And what is policy surrender? And what is policy surrender? Policy surrender means like after a certain, the companies usually give give a possibility of the policy holders to the policy holders to surrender their policies. Like somebody doesn't want to continue his policy because say he is not willing to pay the premiums, or his financial condition is not, or is such that he can bear those premiums, then he may surrender the policy after doing all the formalities, and all the benefits which are due to him till surrender date, after, in accordance with the norms, after deducting some charges, these would be paid to the policy holder. Policy surrender. So what is the role of auditor in it? So he has to see that all these things happening are within the norms. What is the internal control prescribed by this? There are no financial implications involved. Surrender amount is calculated appropriately. Okay, and in case of policy revived, there is a proper check that only those policies are revived which prescribe to norms, which fall within the norms and within the internal rules, internal frameworks of the insurance company. Okay. And there is one more important term in case of life insurance products, that is free look. Free look cancellation. What is this free look cancellation? Yes, Viraj. Free look cancellation. Free look cancellation. Yes, Viraj. You must be having knowledge of this. Enrich us with your knowledge, Viraj. Free look cancellation. Yes, Koshki is saying why this policy lapse. Policy revival is not basically used in GIC in general insurance. Say when the policy, say fire insurance policy has expired, then it is not a continuing policy. So if it has expired and I have not paid the premium, then obviously it cannot be revived from backdate. Because say my policy expired on 31st March and now I go to the insurance company for after 10 days on 10th of April and ask them to renew my policy, to revive my policy. It won't be revived from 1st April. A fresh policy would be issued from 1st April because these risks would be these risks cannot be assumed from retrospective effect. Okay. Whereas in case of LIC, the benefits are there, the person is still alive. So the policy is continuing. No, some charges are always there. And what about policy lapse, Koshki, you are asking? Yes, lapse means that say lapse term is not used because in case of LIC, the policy period is spread over a number of years. And in case of general insurance, the policy is for a period of 1 year. So payment of premium is just a one-time affair. You have paid a premium for 1 year, policy is valid for 1 year. Nothing more is to be done. So at the next time, if you do not pay the premium, or then the policy is not renewed, or you pay premium after some days, then fresh policy would be issued. And in case of general insurance also, when renewal of the previous policy is done, it is just like a issue of fresh policy. Only difference is that reference is also made to the previous policy issued. That it is stated that previous policy number is this much. Okay, that it is a renewal of this previous policy. Clear to you, Kaushiki? Yes. What is free look cancellation? Yes, Viraj. What is free look cancellation? Yes, anybody? तो स्टूडेंट्स नाम से ही पता चल रहा है. Yes, you are nearing to the point. So free look cancellation means it is an opportunity given by the insurance company when they issue a life policy. So they give a time of 15 days to the customer, to the policy holder, to see for the policy. So free look, you can have a look at the policy. You have paid the premium, you can have a look at the policy. And if you do not want, or if you again become double-minded, you say that I do not like the policy, I am not convinced about the benefits, then you can have cancellation of the policy. Okay. So this type of facility is known as free look cancellation. Free look cancellation. Okay. Now, so students, we have broadly understood the working of insurance companies, and we would also now quickly go through the module and to see what is there in your module quickly, because we have to do some questions also. So this is the introduction part. Life insurance, general insurance business, main acts. Okay. And one, yes, this is the very important. This we had left, guys. There is a very important section 64 VB of Insurance Act 1938. This section you have to remember, guys. Section 64 VB of the Insurance Act 1938. So it states that the risk shall be assumed by the insurance company only upon the acceptance of a premium, only upon the receipt of a premium. Yes, whole amount is disbursed. Yes, Kaushiki, you are right. So the insurance company is not to accept the premium, is not to accept the risk before acceptance of premium. Say if the company receives does not receive the premium, it does not receive the check. Okay, the amount is not credited in its bank account, then the risk would be null and void. Then though no risk is, it can't assume any risk. So whenever any claim occurs, so there is in the claim docket file, the insurance companies put a paper separately certifying that Section 64 VB of Insurance Act 1938 has been complied with. It is one of the major requirement before the competent authority sanctions some claim. It has to be certified that Section 64 VB of Insurance Act 1938 has been complied with. No payment, no premium, receipt, no assumption of risk. Simple. Okay. So if the premium is not paid, if the premium is not accepted, then risk assumption is also not there. This pertains to Section 64 VB of Insurance Act 1938. Okay. So registration, every company has to obtain registration. They have to have some capital minimum, paid up capital minimum solvency ratio of 150%. Okay. And there is IRD Act and forms and contents of the financial statements. It means balance sheet, P&L, revenue account. Okay. And there is receipt and payment account. Now, Schedule A, B, C of life insurance business. Schedule A pertains to life insurance business. C pertains to matters contained in audit report. Okay. And B contains to general insurance business. Appointment of auditors is to be done by CAG. Okay. And in case of other companies, by shareholders in general meeting. Rights and duties of branch auditor same as in case of company audit. Directions of CAG. This I have already told to you that CAG can give directions to the for some for audit to the statutory auditors. And applicability of CARO 2020. CARO 2020 applicability is not there, as we had learned in case of banks that CARO 220 is not applicable to insurance companies. Okay. So these kind of things, these are products of some life insurance, and disclosures forming part of financial statements like contingent liabilities. These are all the things which you can correlate. So actuarial process, reinsurance, free look cancellation. Okay. So here is the free look cancellation. Then you have got policy lapse and revival, policy surrender, premium collection accounting. Okay. So all things we have read generally. Investments, the insurance companies have to make investments in accordance with the investment regulations. Okay. Commission. So commission is also, I have told you students that this is one of the major items. This is one of the major items in the balance sheet, in the financial statements of an insurance company. And the auditor would be checking all these expenditure on all these, whether commission is paid in accordance with the IRDA norms. what is the control system, what is the internal control system pertaining to the pertaining to payment of commission. Okay, how commission payment is linked with premium collection. Okay, and whether commission is clawed back on cancelled policies. Okay, then proportionately it has to be reversed if the policy is cancelled. So operating expenses are basically all the management expenses of the insurance company, like audit fees, printing and stationery, employee costs, salaries, employee benefit expenses, legal charges, audit fees, depreciation, all interest, bank charges, all are included in this. Okay. So this is general insurance. Now again, Schedule B is applicable to general insurance. Okay, so Part 1 contains accounting principles for preparation of financial statements. Okay, and Part 2 contains disclosure requirements. So clearly states that Part 1 clearly states that accounting standard 3, cash flow statement shall be prepared only under direct method. Okay. AS 13, accounting for investments, is not applicable. AS 17, that is segment reporting, is applicable, and minimum segments, fire, miscellaneous, and marine, these are prescribed by IRDA. Okay. Premium we have already discussed, reserve for unearned premium. So all claims, we have discussed about claims. We have also discussed about actuarial valuation. And some general things are there which you can read from your module. And there are general instructions for preparation of financial statements. Contents of management report. This we have already discussed in quite detail. Confirmation regarding validity of registration granted by authority, payment of dues to statutory authorities, solvency margins, okay, aging of claims of last 5 years. So all these kind of things, and the format of preparation of financial statements, profit and loss, balance sheet, a revenue account, and receipt and payment account. These have to be prepared. Okay. So now we come to the audit report. What are the contents of the audit report? Now let us go straight to that. Yes. Contents of auditor's report. Now what it shall deal with? It shall deal with that the auditors have obtained, say, all the information and explanation which were necessary. So this is a general point. Whether proper books of accounts have been maintained, this is also the general point. Whether proper returns have been obtained from the receipt from the branches or other offices. So, friends, you have to understand that public sector insurance companies operate through their network of divisional offices and branches. So like in case of banks, there are branches. In case of public sector insurance companies, there are divisional offices. So under one divisional office, 1 or 2 branches could be there. Or divisional office can be a standalone type of divisional office only. So all the workings, all the premiums are being collected through branches and through divisional offices, and policies are also issued by them, and the claims are being paid at the divisional offices. So the audit is being conducted at the divisional offices. So the CAG is appointing auditor for the insurance company as a whole, joint auditors it is appointing, and for divisional offices it is also appointing auditors. Like in case of banks, we had seen that that banks are appointing branch auditors, statutory branch auditors by taking prior approval from RBI. So similarly, in case of insurance companies, auditors are being appointed for divisional offices. Okay. So the auditor would have to state that whether returns received from branch offices are adequate for the purpose of audit. And these are the general things, whether balance sheet, revenue account, P&L is in agreement with books of accounts and returns, and also cash flow, that is receipt and payment account. And one more important thing, whether the actuarial valuation of liabilities is duly certified by appointed actuary. So an actuary is to be appointed by an insurance company in accordance with the IRDA norms, in accordance with the IRDA regulations. Okay. So the auditor would have to state specifically in its report that whether the actuarial valuation of liability is certified by the appointed actuary. Okay. So the auditor will express opinion on whether the balance sheet gives a true and fair view, revenue account gives a true and fair view, same things. Receipt and payment account gives a true and fair view. Financial statements are prepared in accordance with IRDA Act and Companies Act 2013. And special point regarding investments, that investments have been valued in accordance with the provisions of Act and regulations. I have told you that IRDA has issued regulations for investments. So all investments should be made and valued in accordance with these regulations. Okay. So accounting policy, specifically it is asking from the auditor to state that accounting policies selected by insurer are appropriate and in accordance with the applicable accounting standards and in accordance with the regulations, because we had seen that Schedule A and Schedule B contains the accounting principles which are to be followed by the insurance company in the preparation of financial statements. Okay. So the auditors shall also certify that they have reviewed the management report and there is no apparent mistake and material inconsistency. So guys, you understand now why we were discussing the management report. What is its significance? Because in the auditor's report, the auditor would have to certify that management report is not out of sync. There are no apparent mistakes or material inconsistencies with financial statements in the management report. Okay. The insurer has complied with all the terms and conditions of the registration stipulated by the authority. Now, whatever the regulator had imposed, the conditions the regulator had imposed, these have been complied with by the company, by the insurance company. And additionally, they have also to give a certificate regarding verification of cash balances and securities. Okay. And regarding verification of investments, and also to state that no part of policyholder funds has been applied in contravention with the provisions of Insurance Act 1938. Okay, so these things auditor of an insurance company would have to take special care of. Okay. Now guys, are you ready for some questions? Yes guys. Are you ready for some questions? Yes, students. Yes. Are you ready for some questions? Are you still logged in, guys? Yes, drop your mails. Are you ready for some questions? Is the screen visible to you? I am sharing the screen. Is it visible to you? Yes, Janvi, Viraj, Koshki. Yes. Tell me, guys, is the screen visible to you? So, question number one. You are one of the joint auditors of a public sector insurance company engaged in general insurance business. Okay. Discuss how work of actuary can be useful to you in obtaining audit evidence in any one area of operations of the company. Yes, what you are going to write in such type of question? Yes, just tell me what you are going to write in such type of question. Now you are auditor of a general insurance company. Remember, you are auditor of a general insurance company, not life. You are auditor of a general insurance company. How the work of actuary can be useful to you? Discuss any one important area. So what important areas you would write and what you would explain? Yes, yes, guys, waiting for your answers. Now amount of premium. So you are gathering Koshki, you are gathering now audit evidence. You can't write things so generally. Now you are gathering audit evidence. How the work of actuary can be relevant to you. Now here we are not talking about internal controls. We are talking about audit evidence. You have performed certain procedures. Okay, you are in the process of conducting audit. You are gathering audit evidence. So discuss any area where your actuary work can be useful. Risk return analysis. Again, okay, that is part of the job of the actuary, but how it is related to the policy has been issued. Now you are auditing the financial statements. Now this was basically part of more of internal controls. This work of actuary you are writing is more part of control framework structure. So when the policy was to be issued, when the product was to be launched, it was done by an assessment was made by actuary relating to its return and risk, relating to what premium is to be fixed. Okay, but now the policies have been issued. The company is now working and it is receiving premiums on those policies, and the claims are also coming. So, what is the role of actuary in such a situation? January life, the question is not about life insurance. It is about the non-life insurance. It is about the general insurance. So the role of actuary in such a case, the most important aspect would be in estimating what? In estimating claims which have been incurred but not reported. Claims which have been incurred but not reported. or claims which have been reported but not enough reported. So what the auditor usually does is uh, he he asks the actuary of the insurance company to certify that what are the claims which have been incurred and not reported, or claims which are not enough reported, although reported but not enough reported. It means that more provisioning may be required for those claims. So I told you that it is a sort of estimate. Yes, Janvi, you are correctly stating. So it involves a lot of management judgment. So who is expert in making such type of estimates? It is actuary. So the auditors are going to rely upon the certificate, upon the report of actuaries in this respect about the claims which have been incurred and not reported, or claims which have been reported but not enough reported. Okay. Like say claims can happen in many ways. Say in insurance company, students, like in motor claims, uh, there may be awards by courts, by motor accident claim tribunal, MACT, motor accident claim tribunal. Like when a person dies, okay, during some accident, then they award, motor accident claim tribunal gives the award, passes an order giving the award that so much compensation is to be paid to the, so the at the overall company level, what an actuary does is actuary estimates, makes an estimate of such claims depending upon their past experience, upon the past experience of the claims, in accordance with what are the legal requirements which are happening, new laws, new regulations which have come, depending upon the court judgments, depending upon any ruling, like in some cases the company may have won cases through Supreme Court, or in the National Consumer Forum. Okay, so by making an estimate by using statistical tools and mathematical models, the actuaries are making such an estimate. Okay, so it could be an important area in case of a general insurance business, for an auditor, where they can make use of the work of actuary. समझ आ गया स्टूडेंट्स आपको, या इसमें कुछ दिक्कत है? टेल मी. Yes guys, you have understood this? Yes guys. Yes, Koshki, you are asking claim cases which has been incurred but not reported. Say some loss has happened, but say it would, by experience, the actuary knows that there are certain percentages of claims which are reported after a time lag. Say like in motor cases, say a the time till the parties go to the MACT tribunal, it may fall in next year. So there is not a specific parameter, specific measurement for actuary to make in such cases. He can estimate on the basis of past experiences. So they use some models, some percentages to arrive at such number of cases that there could be possibility that such an amount, such a percentage of amount in case of company could fall under the category of claims reported claims incurred but which have not been reported. So obviously the company would be reporting, would be making a provision of the claim only when it comes to its knowledge. So out of prudence, there may be claims which have been incurred but not reported. So the actuary is giving his estimate of the liability of the company in this respect. Yes, Kaushiki, now it is clear to you. Claims which have been incurred but not reported. And second part of this is claims which have been reported but not enough reported. It means that some additional liability may arise later on in respect of those claims. Okay. Now we come to question number 2. Now read this question. CAX is auditor of a divisional office of a general insurance company. Okay, it is a general insurance company. The company has made a provision in respect of claim of due to fire in its premises of one of its policy holders for ₹2 crore. कंपनी ने 2 करोड़ का प्रोविजन कर लिया, उसकी लॉस हुआ है बिल्डिंग और स्टॉक्स का. बिल्डिंग और स्टॉक्स का लॉस हुआ है. कंपनी हैज मेड ए प्रोविजन ऑफ 2 crore. The surveyor appointed has mailed to the company on 12th April stating that estimated loss of building is not payable as insured is not able to submit documents relating to title of building or rent agreement. How would you treat the matter as auditor of divisional office? Yes. Come on, Kaushiki, Janvi, Viraj. Simple question. A claim had occurred, 2 crore claim amount was there. It pertained to building and stocks. So the company had, the insured had given an estimate of ₹2 crores. Now surveyor is sending a mail to the company on 12th April stating that claim of building, loss of building of ₹50 lakh is not payable as the company is not having, as the insured is not having proper documents in relation to building to prove his insurable interest in the building. Yes. So how you should treat the matter as auditor of divisional office? Yes, only Kaushiki has given the answer. What about others? Yes, anybody else? Viraj, Kaushiki. Yes, Viraj or yes, Viraj, have the results come? Have you have the results come or not? Yes, what should be the answer? Yes, Janvi, Viraj, come on. Yes, the answer which the Kaushiki has given is right. So the provision in the books of divisional office should be reduced by 50 lakhs. So provision now should be made for 150 crores, 1.50 crores. So the auditor would see that excess provision is reversed, that now correct provision is made, because for rupees 50 lakhs, the company is not in any way liable, because the party is not having required documents in its possession, and the surveyor is himself stating that the claim is not payable. Okay, so it means that only provision would be made for claim of rupees 1.50 crores. No, Janvi, you are wrong. It is, you are only correct to the extent that claim of rupees 1.50 crore is to be made, but you can't write that insurer should have checked before issue of policy. These things, the client is supposed to provide all the things to be able to substantiate his claims. The agent can only advise. The agent would definitely advise that these kind of requirements might be called from you when a claim will occur. But anyways, the claim has to be substantiated by the insured. It falls under his duties. Okay. Now, Viraj, has it become clear to you on what pattern the answer is to be given? Basically, this question pertains to claim provisioning. जितना ही तो आप प्रोविजन करोगे जितना रिक्वायर्ड है, उससे ज्यादा थोड़ा प्रोविजन कर लोगे. सिंपल कंसेप्ट है. You have to make provision in accordance with probable expenses, in accordance with the liability which is going to befall. Clear, simple, general things, guys. Now, number 3. You are one of the joint auditors of an insurance company in general insurance business. Okay. No, Koshki, it would ask, the auditor would ask the management to correct the provision. Discuss any 5 areas to be included in management report. Do you have any responsibility towards such type of report? Now write some of the areas which are included in management report. We have discussed, I think, twice or thrice contents of management report. Now you are auditor of a general insurance company. What is included in management report and what is your responsibility? So write any 5 points. Yes, solvency margin, license, and others. So students, I want you should remember at least 5 points today itself, in this session itself. So at least 5 points you should remember in this session. Yes, guys, come on. Yes. Yes, one relates to lessons, another relates to shareholding pattern, not only shareholding pattern, but also share transfer. So write, when you are writing waypoint, write it completely, all the aspects, so that at least one point which you are writing, you get full credit. Okay, one is license, one relates to shareholding pattern and share transfer, another relates to undisputed statutory dues. Okay, solvency margin adherence. Yes. And fifth, yes, Koshki, aging of claims, aging of 5-year claims. And this aging is also to be done segment wise in different departments. Okay, so aging period is 30 days to 30 days, 30 days to 6 months, 6 months to 1 year, and 1 to 5 and more than 5. So remember this aging schedule also. 30 days to 6 months, 6 year, 1 year to 5 years, and more than 5 years. So it happens in insurance companies that many large claims, these are outstanding for more than 1 year, more than 2-3 years. It is very common because there are certain issues, there are disputes, and the insured is not able to complete the papers, or the nature of claim is such, it is so complicated that the surveyor is taking time to assess the loss. Many physical verifications have to be carried out. Okay. Clear, students? Yes. Now move on to question number 4. Yes. Read the question, very simple. Yes, a company has given a check of 1.50 lakhs to an agent of insurance company in respect of fire insurance premium. The risk was to have commenced from 1st January and policy was issued. However, the check got dishonored. Fire occurred on 2nd January. What are implications for insurance company? Yes. And also tell me what are the legal provisions in this regard? Yes. Also tell me what are the legal provisions in this regard? Yes. Janvi, Koshki, you are right. So the check has been dishonored, the premium has not been received. So although policy has been issued, the no risk can be assumed by the insurance company. Okay. So what is the relevant section? Relevant section is section 64 VB of Insurance Act 1938. So correct that in such type of question, you have to specifically mention section 64 VB and the name of that. इतना तो mention करने से ही काम हो गया है. The person who is checking your papers, he knows that you know the answer. Okay. Question number 5. Pre-look cancellation in case of life insurance policies is a measure to what? Fill in the blank. Yes. Pre-look cancellation in case of life insurance policies is a measure to what? Write 1-2 words. You do not have to describe. what the fill in the blank is asking you to state its objective. No, Koshki, encourage newly insured. No, this is not. This is too much. This is not objective. Encourage. This is too general. What is the specific objective? What is the specific objective? Although I know it is basically a MCQ type of question, but I have deliberately not given you the options. I have deliberately not given you the options. So once you find the options, you would quickly mark the correct option. But I want you to give it me from your own mind, that what is the basically objective of free look cancellation procedure, free look cancellation facility. No, again, this is also not the case. Pre-look cancellation, what is the general objective? Pre-look cancellation in case of life insurance policy is a measure to, as a general for all the policy holders. What does it tend to achieve? It is a measure to protect interests of policy holders. It is a measure to protect interest of policyholders. So students, you have to understand that there are separate regulations, IRDA regulations for protecting interests of policyholders. Okay. So this is also free look cancellation is a measure to protect interests of policyholder. Koshki doesn't matter. Basically, this was an MCQ type of question. If there were options were given, you would have definitely marked. So I just wanted to make you understand that what is the objective. Probably if I had given you the options, it wouldn't have gone deep into your minds. It would have remained at surface level only. Okay. Now I think you would remember that it is a measure to protect interests of policy holders. Okay. Now number 6, what is the duty of auditor in respect of life insurance policies lapsed and revived while conducting audit of a life insurance company? Yes, guys. What is the duty of auditor in respect of life insurance policies lapsed and revived while conducting audit of a life insurance company? Yes. Yes, Koshki, you are right. One is that all policies are revived as per norms and regulations. And he would be also checking internal control procedure relating to the policies revived, whether this procedure is followed or not. All the deficiencies, yes, that is also correct. And proper premium along with interest has been calculated. has been obtained from the policy holder before the policy is revived. Correct, students? Yes, now we come to question number 7. The expenditure on commission paid to agents is substantial and material while auditing accounts of a life insurance company. How would you design your audit procedures to verify this assertion appearing in financial statements of life insurance company? Yes. How would you verify commission expenditure in the particularly in pertaining to life insurance business? Yes, Viraj. It pertains to you. You have been earlier in this role or supplementing this role, should I say? Yes, students. What are the basic checkpoints which you would check, which you would conduct to verify how you would design your audit procedures to ensure that commission paid to agents in a life insurance company is properly recognized, that it is not misstated, that what the management is stating is correct. Yes, Koshki is writing would get list of all agents. Yes, all the business acquired agent wise. Yes, premium. Yes, IRDA limits are very important. The most important points, yes, Koshki, you are writing correctly. IRDA limits stipulations are very important because say the commission rate is different for different type of business. Okay, like for fresh business, it is different. For renewal business, it is different. Similarly, in case of a say, this question is about life insurance. Had it been for general insurance, then it is commission rates are different for fire insurance. These are different for motor insurance. Okay. So, and what basically first is the system and of the insurance company pertaining to commission, and whether this commission is linked with the premium collected, it is in accordance with the premium, it is in sync with the premium, whether commission paid is in accordance with the IRDA stipulations, IRDA norms, and whether there is in case of cancelled policies, whether the commission is clawed back. Okay, because say policy has been cancelled for some reason, the customer comes, he says, okay, whatever penalty you charge, I do not want to continue this policy. Okay, but the company has paid the commission to the agent on the whole of the premium amount. Now, when the policy is being cancelled, then proportionate amount should be clawed back. Okay. Clear, and the auditor can see that agents are working. There are no ghost agents. Clear, guys? So now only Koshki is responding now. And what about others? Janavi, Viraj, and Bhaskar, are you still logged in? Or I opted out? Question number 8. You are an auditor of an insurance company. Now, this is a general insurance company engaged in general insurance business. How net premium earned and net claims incurred are arrived in revenue accounts of the company. How premium earned and net claims incurred are arrived in the revenue accounts of the company. Yes, do you remember anything? Yes, Viraj. So why you are not sending mails then? Why you are not answering? Probably finding it too hard, or you are stressed for your results, or you already know the results. Yes, so net premium earned. Yes, Koshki. Yes, premium in India, premium outside India, and what is to be added and what is to be deducted. What is to be added and what is to be deducted. Add premium on reinsurance accepted. And less premium on reinsurance ceded. Yes, Koshki, you are writing. And what about net claims incurred? Similarly, claims paid. Okay. Claims paid plus claims on reinsurance accepted minus claims on reinsurance ceded. Okay. And add claims outstanding at the end of year and less claims outstanding at the beginning of the period. So this is the basic thing. Now, Koshki, you are writing there won't be opening advance, closing advance. In case of premium, yes, another adjustment would be there. It would be adjustment for change in reserve for unexpired risks. So, like in case of stocks, you are making adjustments. So, similarly, in case of here, in case of insurance companies, you are making adjustment for change in reserve for unexpired risks. Okay. Yes, adjustment for unexpired risk is there. Okay. Now CAY. Ninth question, CAY is auditor of an insurance company. It is engaged in GIC, general insurance business. He wants to ensure that insurance premium is recognized in accordance with Schedule B to IRDA regulations. That is preparation of financial statements. Advise him how he should proceed in this matter. So what is the most important thing for him to see? In such matter, it would be important for him to see that premium is recognized on the basis of risk assumption. One thing is that. Another thing what he would see in respect of unearned premium. Okay, so In respect of unearned premium, the reserve for unexpired risk is made. Premium is allocated on time basis. Okay. Any premium received in advance, this should not be accounted for in the premium income of the company. Rather, it is only on the basis of it should be shown as a liability. It should be shown as a current liability. Premium received in advance is shown as a current liability. Okay. So claims, yes, Koshki, only claims paid have to be shown. Okay. So clear to you guys? Now we come to question number 10. It is MCQ. Now read this MCQ and tell me what should be the answer. Read this MCQ. A company has received intimation of loss of a fire claim amounting to rupees 10 lakhs. General insurance company. Fire claim intimation. The insured has informed to the company that loss of 10 lakh has occurred. The ILA, what is ILA? ILA is immediate loss advice. Like when surveyor visits the premises, within 1-2 days, he informed the insurance company that what are his primary observations. So in insurance language, ILA means immediate loss advice. So these sort of technical words you should have in your arsenal. Immediate loss advice or say status report. It hints at a liability of 5 lakhs. Salvage is expected to fetch 50,000. Now surveyor fees is 10,000. Now what should be the proper provision to be made by company in respect of such a claim? Yes. Yes, Viraj, Koshki, Janvi. Yes, only Koshki's mail has come. And Koshki, I would also like, you have given the answer, I to mail how you arrived at the answer. What is your logic for arriving at the answer? Also mail to me that aspect also. Yes, yes, guys. So obviously the party has given, the insured has given intimation of 10 lakhs. So this amount is irrelevant. This is just an estimate of the loss which the insured is saying. Now, what is the actual loss? The insurance company would be ultimately relying upon the surveyor report because he is the independent person deputed to assess the loss. So his preliminary observations are that liability should be around 5 lakhs. And he is also stating that further to above. So salvage is expected to fetch rupees 50 lakhs. That whatever damaged material is there, it would realize 50 lakhs. So 5 lakh, the company would be paying 5 lakh less 50,000, 4.50 lakhs. So liability would be around 4.50 lakhs. But the surveyor fees which the company would have to pay, the expense it would have to incur, it is also part of the claim cost. Okay, so the correct amount would be 4.60 lakhs, because associated claim costs, these are also part of the claim. These are also part of the liability which has fallen on the company on account of the claim. So yes, your answer was right, both Janvi and Koshki. Option C, 4.60 lakhs. So yes, guys. So within the time frame allotted, students, you must. I think that you have got an overall uh, view of the of this chapter. Okay. So I think many things would have got clear to you, and probably when you would read the chapter from your module, your horizon would be widened. Okay. So yes, Koshki, we are talking about the financial statements of insurance company. Okay, so it can be booked as a separate expense or part of the claim. Usually it forms part of the claim. Okay. So other expenses like some fees paid to lawyer, etc. These which is not directly attributable to it, it can be shown separately. Okay. So it's over for today, and my best wishes to all of you guys. If you have not got your result, and if you do not get result according to your wishes, or if the result is not favorable, then better luck next time. It is not end of the road. So it's over for today, and guys. Probably you would complete the remaining chapters of auditing within this month. So all the best for your preparations, and for your, not only for auditing but also for other subjects, and wishing you a happy preparation time and a bright future. Okay. So thanks students for listening me. Okay. For listening me. Thank you. Yes, yes.